Down by the elevator, the market has been hit hard and is now down another 10% from the recent highs. All in the environment of aggressive rate hikes, eye-watering inflation data, central banks winding back the stimulus. Still, we have supply chain issues and geopolitical tensions from Europe all the way through to the Indo-Pacific region. Now, positive economic headlines are struggling to seep through the media. And to discuss all these impacts, we're speaking with Gary Glover from Novus Capital, covering the macro side, his short positions, and what to look for in the companies in his short list to buy. It's a lot to cover. How are you, Gary?
I'm pretty good, Chris. Yeah, quite a lot there in there, really.
Well, I was reading your report and I thought there was a great summary in there, and you've talked about all of those macro things, and I just thought there's not much positive coming through, and I don't know, are you finding any positive macro headlines in all of that list?
No, it's funny there because obviously, it's sometimes, as traders here and even market participants there, you just got to apply a bit of common sense sometimes. With last week there, everyone was sort of talking about peak inflation, and the worst potentially is behind us, and but if we know in our own lives, if you can't, if you look at all the inflationary costs, I can't see one of those measures that have actually the markers that have come down, Chris. Oil prices continue to go higher, travel costs are higher, food costs have gone higher. Everyone's adjusting prices higher at the moment, so it was just sort of I found it quite bizarre, sort of leading into last week, how many people were talking about peak inflation. I thought, wow, okay, well, common sense would have telling me that there's no way that number was going to be a low number, because I haven't seen anything inflationary that's gone lower yet. So, even my kids and we were talking about inflation now at the local kebab shop there, getting some guys lemmies last week. That they were putting their prices up while we're sitting there having some lunch. It's just, inflationary pressures are everywhere at the moment. Everyone's feeling them there. They're all on the increase. I haven't seen anything peak here yet and come off here yet. So, yeah, we really need to start sort of seeing some of those start to subside first before we can get too excited here. So, but yeah, so we're going to go a bit lower here. I'm a little nervous that some of the targets have been achieved here a little quickly. So that means potentially we might overshoot on the downside. But I still think looks like equities are going to head a bit lower here, and we should be definitely hanging on to our SNAS and BBUS until we get back to some lower levels.
Well, that's a good point. We'll come into those because you've no doubt had a busy morning. You've been on the right side of the market for a long time now, and it's tanked since we last spoke. It's also tanked since you wrote up this report. So we'll cover your short positions and how you manage them. Probably maybe not spend too much time on covering your entries and how you came up with the targets, because that we've covered in many episodes over the last few months. So anyone who wants that can go back into the playlist. Now, you were looking for a low in the last part of June period. In your report, you've said not losing money is in the next month should be the main priority. So with that kind of overarching message, you look at the NASDAQ, what are you seeing here?
Yes, we talked about that bearish spacing there last week, how so far the rallies have been pretty mild. So the first rally was okay, and then failed here. The second rally there, we saw really low participation. So this is when, if you can get access to volume and and data and stuff there from different sources there, you can sort of see that we were rounding on very, very light volume. And any time we were we're starting to see a little bit of selling coming after those rallies. The selling was much more, the volumes were, a lot higher there. So it's just telling us here that this rally was so weak, and, not to get too far in 3 weeks, and the volumes are light. And then every time we got up to a reasonable level there, we saw some volume sort of stepping in. That's not a good sign. So just sign of weakness there. And that spacing there, once you see that bearish spacing, the rally basically staying well underneath the previous swing low, that normally means you're going to accelerate to a new low, Chris. So that was telling us last week here that we were going to accelerate to a new low, which is exactly what's been done here. But still everything points to 10,000 to me, going back to the old high there, but we are starting to accelerate here. So, one of the things I mentioned there, probably, I've always had this sort of target in mind here to come back to the old 2000 high, but can't rule out an overshoot here as well, considering what's happening. Yeah, there's a pretty scary level, been highlighted there for a long time there, just because that's sort of where that last accelerating trend line sort of started from. A lot of stocks can have it, but yeah, can't rule out the NASDAQ overshooting here and going beyond that. But we definitely just shouldn't be giving our SNAS away until we're at least sort of cracking the 10,000 mark, I think. So yeah, I've instructed my clients to sort of hang on to the SNAS and BBUS here. So there's a good chance we'll probably get we're going to get the rate hike here in the next session or two there in the States there. So everyone was convinced we're getting 50. We might be getting 75 now. So yeah, that's just going to cause a bit more tension for markets as well. So yeah, so we're just going to see how it trades into 10,000 and review there. So we'll probably sell at least some of them into 10,000. But yeah, it looks like we're heading that way.
And on the S&P 500, I think this is the old high, the 3,400 that you were talking about in the 2020. So just before COVID, we came up, touched that high, got belted into the COVID lockdowns. And that's the sort of the bottom end of the region that you've been targeting for some time. But that's before we've just had this week in the US. So is there spacing? Is there distribution days? Is that moving the target, or are you still same thing? Look for that target, reassess when you get there?
Yeah, pretty similar to NASDAQ there. Probably not as weak as the NASDAQ. Obviously, the NASDAQ has left a couple of spacings there. The Dow Jones has sort of been more of a, what do we call it, like an overlapping trend there. So not as weak as the NASDAQ there. But the S&P still has stayed underneath the previous swing lows. It still leaves it in a pretty weak position. And again, if we drill into that there, you saw there that we going up on really light volume. Every time we get up to some high prices and we see a couple of down days, we see really aggressive volume stepping in, selling. So again, it's a pretty negative sign there. We just saw a couple of, I think we saw 2 or 3 distribution days last week in the market, Chris, which is sort of like normally we're sort of, if we see those in a cluster over a few weeks, that's a bad sign. So to get 2 or 3 distribution days in a single week there, that's pretty bearish. So that's when we're basically down by more than 0.2% on the previous day, and the volumes higher than the previous day. We just don't see that many of those in a short period of time. So that's pretty bearish as well. So so again, looks like we're heading back to that 3,400. Always had this sort of end of June, early July as a bit of a, it's really my first timing for the year. It's the first probably timing I'm looking for. But yeah, we've sort of gone to a new low here, obviously on Monday, because obviously doesn't have Monday session in there for the NASDAQ and the S&P. But yeah, we're looking for at least 3,400 here. So I'd just be curious to sort of see how it trades down there. But we're kind of now getting touching distance within these levels here. But yeah, just got to be a little cautious coming in here. So but yeah, I guess the good news is the Aussie market has always tend to sort of outperform the US market here. So it's interesting here that we've actually cracked those levels today. We've actually gone down to 6,600 or something. So really got down to some sort of key levels there. I thought maybe that 65 there might be a bit of a level to watch there. That's like a third of the range. I'd say not expecting a massive, not expecting us to sort of, go too far down here, just to overshoot that previous low, which we've done here. So, yeah, hopefully we can, I just noticed in the past that we might show signs of bouncing sort of early and show a bit of relative strength there. So, yeah, I think, you really need to sort of get your shopping list out, start looking at the sort of stocks and the levels you like there. And then if we see a bit more weakness here into the month there, we try and identify the stocks that we're looking at here. So not all of them will find the low at the same time. Yeah, so we've hit a bit of a key target zone there. Just probably got there a little earlier, Chris. That's my only fear. We probably probably 2 weeks early. So what does that mean? Does that mean we're going to go a bit further down? Possibly. Yeah. So
Okay, so still, excuse me, still bearish on the ASX, just not to the same extent as the S&P and nowhere near as much as the NASDAQ. Now, is where, as you said, coming into that, it's come there a little bit faster and come out quite heavily. If we were to draw today's candle, it's a big, heavy candle bashing straight through there. The speed at which it leaves this sort of box or this sort of sideways congestion, is that more concerning if it leaves it very quickly as opposed to sort of just dribbling out?
Can be there. Just it's been sort of impulsive anyway. The sell-offs anyway so far. So even the last few sell-offs have been happen within a short period of time. So yeah, not necessarily there. Just probably more anyone who sort of followed my work, I do look at price and time. So I think price is probably the harder one to pick sometimes. The timing actually is sometimes easier and a bit more reliable. So some of the sort of stronger timings I've got for a low here are still a couple of weeks away at least. So that's telling me here just not to just to be cautious here. Maybe we're gonna overshoot here. Maybe I don't know. Maybe that 200-day moving average is possible. Who knows? So all I know is that it's hit our target, but it still looks pretty weak here. If we're venturing in slowly. So I've been using a little bit of using the vol today to sell some puts on stuff that I like. That if I'm picking up 4 or 5% premiums, then I've got a 4 or 5% buffer on my entry, which I think we might need in this market. So yeah.
Okay, so that's one way of entering. But you mentioned sort of get that list ready, know the levels. Obviously, you're working with that 5% odd premium on the options to aim for those levels or below.
Yep.
If you're running through the list that you've got in today's report, Temple & Webster is one of the ones that comes up. Is that one of the companies that you'll be having on your list to watch for a turning point?
Yeah, I think this is sort of one of the market darlings here. So I just sort of highlighted this to, obviously we've seen some of the growth stuff in the US there, but we've seen plenty of growth stuff in Australia. So, to me, the buy now, pay later, I'm not sure that was really a legitimate sort of sector. Me personally, I just think I don't think any of them are profitable. So, so I'd rather look at businesses that are profitable and have been profitable. So I still think Temple & Webster is a pretty solid brand, pretty solid business. Obviously had a great run through COVID and stuff there, but has had a massive correction as well. So we've, this 80-50 rule there, sort of 50% of these growth stocks will correct 80%. We're almost there for Temple & Webster. So we're basically, the price has fallen 75% from its peak there, $15 down to $3.74. So just looking there, sort of technically just some old levels there. So somewhere around $3 there might be interesting zone there. So it's a business I still like here. And I think, sort of when growth gets crunched here, at some stage you got to venture back in there. So there's some growth stocks that I will look at there. So Temple & Webster is sort of one that I think is still a pretty good business. And that my deal's been taken out by Woolies there. So Kogan, I don't mind Kogan, but I think Temple & Webster is probably a better brand. And there's a few other businesses as well that worth looking at as well.
Okay, well, if we move towards the bank side, because the Australian indices rarely move without the banks being on board.
Yeah, correct.
That's travelled sideways. You've got ANZ moving in a bit of a box, but it's been failing to push through new highs over the last few months. So how does that fit in with the chart and what you're going to look for from ANZ?
Yeah, so just thought it's worth highlighting this chart. It's really, it's pretty impressive sort of distribution pattern for ANZ. Really, basically, I know McLaren used to sort of call it the 0, 1, 2, 3 pattern. When you get sort of 3 lower highs setting up, that's pretty bearish here. But this has got 5 lower highs here, and then now the thing's starting to accelerate down here. So these are sort of pretty strong, pretty bearish patterns here. So Yeah, so I thought 22 was definitely going to be on the cards. I think we highlighted this one probably a couple of times over the last couple of months as a bit of a bearish concern. But around that sort of 2180, 2185 there, that's the 50% of the range. That's the minimum we'd see. We've overshot that today. Probably, I'm kind of favouring a move towards $20 here. So I think this might come back in the 20s. So that's probably a point where I'd probably get interested in the stock here if we get down near $20. So running ahead of schedule for a lot of these stocks. Had some pretty deep pullbacks, but yeah, maybe we can go slightly lower here. But yeah, probably getting worth getting your shopping list out here soon. And yeah, so ANZ's one that's led here. So Macquarie is probably the strongest bank, so I probably worth putting that in there as well. That sort of overshot the channel there. Looks like a nice ABC big three-wave correction now. So 161 is sort of the minimum it should come back to. So I think it's gotten back there today. It might come back to 144 possibly. I probably favour a move to the old high there, which is around the 153. That's probably a more dominant position there. So if I ended up with the stock at 153, I'd probably be quite happy with that. So yeah, it's just a tough one, tough stock to buy. On the downtrend all the time, it's just pretty resilient stocks, pretty strong stock. Obviously, some pretty good growth there. I know there'll be some concerns there regarding its growth there, but I still think maybe around that 153 zone there is probably good buying for Macquarie.
Now they are a bank, Macquarie, but if we look at the banks as a whole, they're also quite heavily exposed to the property market, the Australian property market. At the start, you mentioned rapidly rising interest rates, which can hurt the home buyers. So in that residential property market, there have been some absolute stellar performance that have ridden the wave of that property market. REA Group is one of them. They've been on the nose since that inflationary pressures and interest rates of the commentary from the RBA has changed. What does that look like on the charts?
Yeah, so I mean, REA's down what 41, 42% or something. I think the domain's off more than 50%. So big price corrections there. So that's kind of, oftentimes when you see those sort of stocks have those massive pullbacks, it's usually a bad sign for sort of property there. And obviously, if we're getting a bit of a growth crunch here, which we are, a bit of an asset crunch there, you're starting to see all the asset classes, feel the heat here. Then obviously, property is going to feel, going to be feeling it as well. So I do think it's probably an indication here that probably going to see some real weakness in the property sector there. I don't know what percentage that equates to. It's always held up pretty well just because of Australians' tight property structure, but it just indicates that property is going to cool off here. But yeah, I mean it's a pretty big correction here. These are sort of stocks that have typically bounced back, and oftentimes actually when the property market's struggling there, people probably got to advertise more, So, but I just notice these stocks they tend to have these big sort of corrections there. They are sort of growth orientated there, but some massive corrections in there so far. So something like REA, I think around 88, probably get interested in the stock as well. I think that'll be a fair, decent sized correction there. Coming back a pretty solid move there. So I do think they tend to bounce back pretty strongly, stocks. So so I think REA around there is I'll probably get interested. I think in Domain has had an even bigger crunch there. I actually prefer to use Domain now for some reason, so over REA. But yeah, again, that's had a $6 crunch here back to I think it's what 270 or something, maybe a bit less here today. So so 260 is a bit of a level there to watch out for, and then there's every chance here we might even come back into the low twos there. So this one could really get us an opportunity. So just some good quality companies there, feeling the heat at the moment. So interesting here. I think I was sort of interested in waiting in some of these stocks here, but I've been a bit patient here so far. Just gotten there a little early, but our index is typically shown some resilience before, so don't be surprised if we show a little bit of resilience here. But Probably just got a bit further to go with the US equities. So, but yeah, some of these stocks here are definitely starting to show some value finally, which is great.
Right, so they've pulled back. You've got those Fibonacci levels sort of helping figure out sort of the buy zones that you're happy with. And then you did mention options and that sort of thing that you do with your clients. If people want to know more about trading options, particularly with portfolios and getting entries, they right to contact you on the details on screen there, Gary?
Yeah, certainly. Thanks, Chris.
Thank you, Gary Glover from Novus Capital.
Thanks, mate. See you.